Hello and welcome to the latest update on the macro and general financial markets. What a volatile period it's been. What I'll try to do is run you through a little bit of the macroeconomic results that are driving the market, and also give you an update on what that might mean for the mortgage market, both pricing and for our customers. So inflation has spiked. You can't really open a newspaper or check a website without hearing about cost of living. Luckily, we're no longer talking about COVID, but this is going to be pretty tough for a lot of people as well. Affordability tests have been, or some affordability assessments have been really robust over quite a long period. So we're hoping that, and the analysis supports, I think, that customers have a decent buffer in terms of affordability. But as cost of living goes up, interest rates go up, everyone is going to be under a little bit of pressure, as you'll see from the numbers in this presentation. So right, let's jump straight into inflation and risk-free rates, or swap rates, as you often hear them referred to. So I'm sure you've all seen the data on inflation here, the blue line on the left-hand side, just an astronomical rise, just almost vertical, that chart there, and really even going back to the early 90s, when those of us that are young enough to remember can remember the 8% rises. We're well north of that already. And what's different here this time is central bank rates are still very, very low, and so there's potentially a lot of interest rate rises to come, and we're beginning to see those. If you look at the chart on the right-hand side, you can see there we're really continuing to have another period of negative real wage growth, squeezing consumers, squeezing all of us, as basically inflation just outpaces what's going on in wages. And I guess one of the big things you hear talked about by the economists is the idea of wage inflation pushing through to drive core price inflation even higher. Good news is unemployment is low, so overall I think people are not worried for their jobs at the moment. It's more about how can they pay their bills. So if we go through to the next slide, just move this one. Here we go. So what's actually driving the cost of living? And I think this is a very interesting one. So if you look at the blue bar there, that's housing and household goods and services. You can see a rapid growth in that one and driving the inflation higher. Transport in red also driving prices higher. And these are very difficult things to cut back on. Recreation and hospitality, I guess we can go to the pub and restaurants a little bit less, but it is nice to have some downtime. But I guess people can cut back a little bit on that, but moving the green bit down or squeezing the green is not going to have a material impact when the blue and the red segments are so high. So it's going to be tough for a while, as basically everyone is hit by this and find it very difficult to avoid driving to work or to basically run your household. So you can see here what's really driving that quite significant change in household expenditure overall. So let's talk a little bit about what that means for the mortgage market. So in terms of interest rates, you can see here on the left-hand side some UK mortgage rates, and you can see there that SVRs have broadly been stable. They've picked up a little bit, but really where the move has been is in that 2-year and 5-year fixed. You can't kind of see the blue line, it's hidden underneath the red line on the far right-hand side of the left-hand chart, figure 4. But you can see there that those two rates have been moving up quite significantly. And I think that the one that's sort of interesting is the right hand chart here. So what we've got here is the 2-year swap rate, is that black dotted line, and you've got the red line is the sort of high street average, sort of high street rates. You can see there the footnote who that's from, and you can see that high street rate is really tracking where swap rates are over the last sort of year or so, just under a year, or maybe since September 21. There's a little bit of a dip there early on. Just to give you a feel, that swap rate is now up at 3%. So if you think that red line is going to continue following the dotted line, and the dotted line's at 3, that means the high street mortgage rates are going to 3% for a standard 75 LTV loan, which is a material increase from the 1% that customers were able to achieve back in late 2021. As you can see there in the specialist market, we haven't seen that direct move, but it's beginning to filter through. You can see the pricing has picked up, and you can see there Kensington has sort of moved up our rates from the sort of low 3s to close to 4%, as we have to pass on the cost of our hedging in the swap market. So, it's based the message there, and I'm sure you're seeing it, is rates are going up. So if customers need to get a new loan, the sooner they do it, the better. We're also seeing here, in terms of specialist mortgage lending, specialist mortgage lending share is in the way we calculate from 27 Tech is keeping pretty constant, or even increasing. If you look back in sort of, I guess, mid 2020, we thought it was about 6%. It's now moving somewhere sort of between that 7 or 8%. So, I guess one of the things we thought would come out of COVID was more customers are complex, and that seems to be coming through. And I think you can also see in terms of the top chart there, in terms of volume, demand side volume is still really good, and KFIs here are keeping pretty good. So that's actually for the whole of the market at the top there. In terms of term of mortgage products, what are we seeing there? And I think this is an interesting one, given the expectation of rate rises due to inflation. And you can see here on the left-hand side for owner-occupied loans across all lenders, this is UK finance data, less than 2 years beginning to drop. So it was about 45%, now heading down to 35%, whereas 5-year, which was around 50% in early 21, is now sort of north of 60, and I think that's going to increase, and really significant changes from back in 2016, 2017, where the vast majority of loans were 2 year or less. Now they are the minority. Less than 5 years also growing, and I think greater than 5 is also growing. And then you can see on the right-hand side the kind of equivalent data for our side, where we're still seeing in the specialist sector a lot of 2-year fixed, but probably not surprising given a lot of the customers come in and at some point their complexity will be cured and they will go back to the mainstream. So you can see why a lot of customers in the complex and specialist space want to go for the 2-year fixed. So what does it mean for Kensington customers? I guess this question we get asked an awful lot in the capital markets. Are mortgage customers going to fall into arrears? Can they afford this increased cost of living? What happens if interest rates go up? All very valid questions, and certainly something that for us it's important that we prepare ourselves for, so we make sure we've got the right resources to help our customers through any tough times. So what we've done here is in terms of our affordability. So 100% here would be that the loan is using up all of the customers, or the customers taking out the maximum amount of loan that they can. Over 100% means that they're taking out less than they can, so they have excess affordability, basically. So we can see here, if we look at, let's just say figure 10, the top right hand side, all KMC borrowers by region, you can see here that it's almost always above 100%. There is some geographical distribution. We'll see a bit more of that later on, but broadly well in excess of 100%. So the good news is customers have a lot of excess affordability, and when that was calculated using their expenditure, or the ONS calculation of their expenditure, and the interest rates using the Bank of England stress, if it was on a 2-year fixed, and therefore we think that they can they've got excess affordability even with higher interest rates, and so we hope that that will be enough to cushion customers through this period. If you look at the difference there on the figure 11 and 12, some data there on the difference between our first-time buyers and also on our self-employed customers, where you see again that the self-employed customers have some pretty good affordability to protect them, and that kind of makes sense because often they'll have more volatile income, and so it's good that they've got that extra buffer to protect them in the case of interest rates rising. So as I said here, a little bit more data here on region. What you can see is that London and South East have the lowest affordability, even though people in those regions typically earn the highest. The cost of living is even greater, so the ratio really of house prices to incomes is worst in London South East, as many of you will know, and that has an impact on on their affordability. And then age is an interesting one as well. Here you can see as customers get older, maybe they've got a bigger deposit, here they're able to have much better affordability, and really one of the very probably the biggest driver of variability in excess affordability is this age factor, which you can see there. But you can also see the difference between first-time buyers and self-employed, which I mentioned earlier on, coming through very clearly in this data. And then finally, a slide here on the market versus KMC. So you can see by those different age brackets on that right-hand table here that you can see that sort of the specialist space, so using yourselves as an example, typically have a slightly higher bucket across almost all maturity or age buckets, maybe except for the sort of the 45 to 55s, but particularly in those younger sectors where the customers have slightly less of excess affordability. You can see there that we generally have a little bit more in the specialist sector, which again, given the complexity, is a good sign. So I guess the key takeaways from me would be that interest rates are rising in both the swap rates and in sort of overnight or central bank rates. Swap rates are now at 3% or higher than that, and if that's continuation of high street rates tracking swap rates, we see more of that, then you can expect sort of 75 LTV high street owner occupied to go to 3%. Specialist market seems to be correcting for higher swap rates as well, but it's taking a little bit longer to feed through. But and customers, basically in terms of affordability, are really going to feel it in the household goods sector or section of their expenditure. But hopefully the interest rate stress buffer that we've had to use in the past, plus the sort of the excess affordability that you can see, means that customers will certainly be able to weather this storm for a little bit. So with that, I'll hand you back.